Central banks were built to protect us from inflation, from recessions, from chaos. But what happens when their mission becomes impossible? In the United States, the Federal Reserve has a dual mandate. Keep prices stable and keep people employed. Simple in theory, in practice, a paradox. Because fighting inflation often means killing jobs, and protecting jobs can mean letting inflation run wild. Inflation isn't just a number, it's erosion. It eats away at purchasing power. $1 today buys less tomorrow. In 2022, US inflation peaked at 9.1%, the highest in 4 decades. For low-income households, food and energy costs spiked over 15%. Businesses couldn't forecast, workers couldn't negotiate, and when central banks look powerless, trust in institutions begins to crack. Interest rates are the central bank's weapon of choice, but it's a blunt instrument and a slow one. Raise rates to tame inflation, but you risk recession. Lower rates to boost hiring, and inflation persists or accelerates. This is sticky inflation, the kind that doesn't fade with a few hikes. Driven by supply shocks, wage pressures, and geopolitical instability. It lingers, it resists, it traps. Governments love GDP growth. It fuels borrowing, spending, and confidence. Higher GDP means higher tax revenues. It improves debt to GDP ratios, making debt look sustainable. But here's the trap. If inflation is sticky and rates rise, growth becomes fragile. Borrowing costs spike, investment slows, and the illusion of fiscal space begins to crack. This is the debt growth trap. Rising rates lead to ballooning debt, squeezed spending, and slower growth. Tight monetary policy cools hiring. But job losses fuel populism, instability, and political pressure. In the US, every 1% rise in unemployment costs roughly $50 billion in lost output. In Europe, youth unemployment remains a powder keg. Election cycles amplify the tension. Wage stagnation breeds resentment. And central banks, supposed to be apolitical, become political lightning rods. Governments are drowning in debt. The UK's debt servicing costs quadrupled to £105 billion per year since 2020. In the US, interest payments now rival defense spending. Higher rates make it worse. Budgets get squeezed. Spending cuts follow, or worse, risky borrowing. And it's not just the Fed. The European Central Bank faces north-south fragmentation. The Bank of England juggles stagflation. Emerging markets face capital flight and currency collapse. Even China and Japan, with radically different playbooks, face their own doom loops. China's growth-first model risks shadow debt. Japan's ultra-low rates threaten currency stability and fiscal blowback. Investment slows, productivity stalls, the economy loses momentum. High rates discourage innovation and hiring. GDP growth stalls, tax revenues fall, debt ratios worsen. Investor confidence erodes. Markets get jittery, and the doom loop tightens. Monetary policy isn't just domestic, it's global. A strong dollar hurts emerging markets. It fuels capital flight, dollar-denominated debt crises, and inflation imports. A weak euro fragments EU cohesion. Southern economies need stimulus. Northern hawks demand discipline. Central banks become geopolitical actors without a mandate, and every rate decision echoes across borders. Can we break the loop? Some say AI-driven productivity could boost growth without inflation. Others look to crypto hedges, a way to escape fiat fragility. Governments explore fiscal pivots, targeted spending, industrial policy, green investment. But none are silver bullets, and time is running out. Low rates combined with sticky inflation create stagflation risk, fiscal fragility, and central bank paralysis. The Fed can't win. The ECB, the Bank of England, the People's Bank of China, and the Bank of Japan can't win. So we ask, if central banks can't win, who can? This is Orbital Strategy, clarity and complexity. Subscribe for more altitude.